webcast of Governance Dialogues, a program that I have the pleasure to host on a weekly basis. My name is Alissa Kole, and I'm the Managing Director of Governance Center, a think tank and advisory firm that works with corporates and policy leaders on advancing corporate and economic governance priorities. And through these webcasts, for those of you that have not yet perhaps had a chance to tune in, we are exploring various governance priorities with the world's thought leaders on economic and corporate governance. And through these dialogues, we're trying to give you, our global audience, an insider perspective, and one that we believe cannot be necessarily gleaned from academic papers or newspapers or other publicly available dialogues, and a perspective that is unique and specific to this format. And how does one get an insider perspective other than in conversation with insiders? And here, of course, I'm not suggesting that today's dialogue will be giving you insider trading tips. Actually, quite to the contrary. We are fortunate to host somebody with enormous experience actually looking at corporate reporting and understanding when there are issues with insider trading, understanding whether there are issues with other types of corporate fraud. And I think it's a fascinating conversation at this juncture as we're trespassing this crisis. We're fortunate to host Anthony Scilipoti, who's the CEO of a boutique investment advisory firm, investment research firm based in Toronto, but who also has a global perspective. Anthony, welcome to Governance Dialogues. How are you today?
I'm great. Thanks for having me, Alissa.
Thank you. And so maybe let me just say a few words before I hand over the floor to you, a few words on your profession, if I may, and why I think investment research is so critical at this juncture. You know, we often say that investment research is a little bit like fresh air. It's a little bit missing these days because, as we know, there are such enormous conflicts of interest in the industry, but also in many emerging markets. There are, simply speaking, not enough investment research. So, for example, when I worked a couple of years ago in Egypt, where we did a large advisory project for the exchange and the regulator, only about 20% of largest listed companies were actually getting any decent investment coverage, and many were getting none whatsoever. And yet we know that investment advisory, investment research is so critical to investors' understanding of corporate reporting and of challenges that corporations face. So it gives me, for that reason, great pleasure to host you. I've known Anthony for about 20 years, and in this time he's built a very impressive enterprise in Canada, but also that has an understanding of similar challenges, reporting challenges all over the world. And I think one of the reasons that I find this conversation will be fascinating is that you make accounting, and including forensic accounting, sound like something out of Agatha Christie novels. So I really hope that we'll have a chance to talk about some of these episodes that you've been investigating in the last few months. I won't go through all of your titles, they're numerous, but just for the purpose of introducing you, I think suffice it to say that you have a CPA, you're a member of Association of Certified Fraud Examiners, you're a licensed portfolio manager, and among your other hobbies, you're also an advisor to the Canadian and international standard setters, the Ontario Securities Commission and the International Accounting Standards Setters Board. Let me just perhaps start with saying the obvious. In your industry, you are a huge advocate for investor rights. And as such, I would like to start off with a little bit of a controversial question. As we both know, Warren Buffett once famously said that when the tide goes down, you really see who's been swimming naked. And I would like to ask you if you think that this particular phrase actually applies well in the current context, meaning once this crisis subsides or is subsiding, hopefully, are we going to see more corporations swimming naked?
That's an excellent place to start. So what I like to think about it is this way. We're looking for companies that are going to cheat. And in order to identify or find these situations, first off, you have to think like a criminal. So the first things that we think about is, okay, if I were to do something wrong, I only do something wrong if I need to. That is, my business is failing, it's faced with a shock. So what we found over time is companies will push the envelope on accounting and or potentially governance issues when they're faced with an economic shock or a competitive shock. And so in this case, they're faced with a significant economic shock. So what we expect to see happen is the first stages. Companies will start to stretch certain accruals. They'll start to modify judgments on and certain assumptions that they're using to assess valuations to delay impairment, for example. In other words, ways that they can make their business seem perhaps better than it otherwise might be given the pandemic.
That's very interesting. In your sort of observations or analysis of the financials right now, especially at this time, are there specific signs that you're looking for that would be perhaps different than under quote unquote normal circumstances?
For sure, as I was alluding to. So I'm looking for changes in discount rates used to value assets. I'm looking for changes in revenue recognition policies that companies are using. I'm looking at differences in way presentation occurs on the cash flow statement. So there are ways that companies can make their free cash flow and or operating cash flow look otherwise better by just delaying payables or using off-balance sheet financing vehicles to bring in receivables, and that moves the otherwise operating cash flow into the investing cash flow. And really, if I had to summarize all of this, this is a time when the details matter. And this is a time where you're going to be able to identify those companies that were swimming naked before, because now that the tide goes out, you're going to see it, and they're going to have to cover it up with patchwork, or those companies that are swimming, fully clothed, and it doesn't matter what level the tide is, they're going to be just fine.
That's interesting. And actually, I would like to make a parallel to another conversation we've had on governance dialogues with somebody that both of us know very, very well, and is Canada's prominent governance expert, David Beattie, who spoke about, from a slightly different perspective, that companies are in a way rendering themselves naked, but through aggressive share buyback programs that existed prior to this crisis, that renders them all the more vulnerable when the crisis hit. But let me turn perhaps now to a slightly different question and go back to some of the responsibilities you have with advising the standard setters. And one of the things that, of course, and we've all been observing is regulators all over the world essentially deferring or modifying corporate reporting requirements, deferring annual, quarterly reporting, and companies. Many conversations that I've been part of are debating whether to actually take advantage of these deferrals to postpone their communication with investors. What do you think are the risks of this move, this sort of deferred disclosure at this point in time?
So I have to say that it rubs me the wrong way, and this is always what happens. So change only occurs when there's a shock. And I've seen it, having gone through, the dot-com bubble. We were making noise that companies weren't generating cash, and we were negative on the Nortels of the world and the Celesticas, and commenting that they're stretching their accounting, and especially at the time, the growth of non-GAAP metrics. And they put a rule in place in 2004 in both Canada and in the US, Regulation G. And that kind of set the groundwork. What I always say happens is as the moment that a regulator puts a rule in place, the moment you tell me what I can't do, you've told me what I can do. And so in that being the case, we've seen the use of non-GAAP metrics, and I think this is one of the roots of all evil associated with financial reporting, grow to such a degree that roughly 80% of the S&P 500 uses non-GAAP metrics as a key metric to measure their performance in their securities filings. That's not audited. It can be changed at will, and it's subject to management's determination of how it's calculated. So what I think's happened is this rule now has gotten a little bit out of control. And I can look at the last downturn, which is obviously the great financial crisis, and we said, there's a problem. our financial system was under duress, and the auditors and the accountants weren't ahead of it. They didn't warn us. There should be a better mechanism for determining asset credit losses. So they took years of debate back and forth, and finally, the International Accounting Standards Board 3 years ago said, "I tell you what, we have this policy. We're going to call it." Lifetime credit losses, okay, then you're using an expected credit model instead of a incurred impairment model. And so, long story short, what that did was it said that when management teams were going to assess credit provisions, they were going to do it based on the lifetime losses that could be incurred by an entity. In the international world, there's a little bit of a caveat. There's different buckets. In the FASB went a slightly different way. Regardless, where I'm going with this is this was very stringent. And what actually happened now is we're faced with COVID, and you had FASB come out and say, it's okay. Companies can actually modify the presentation. International Accounting Standards Board said, you know what? This is how we intend the policy, the accounting provision to be interpreted. And the last point on that is our regulator in Canada, OSFI, the Office Superintendent of Financial Institutions, said, you know what, we're going to provide you with an extra buffer so that when you're setting these provisions, we won't include certain ones when you're calculating your CET1 ratio. So it's in some ways frustrating that we get to a point and then we're faced with the shock, and it's like, well, we don't really want that to be that surprising to investors.
I think, fascinating details, but if I zoom in into sort of the big picture message there is, as you said, when you told us what we can't do, you've told us what we can do. And I'd like to go with that message in a slightly different direction and explore another important accounting concept, which is one of materiality. And we're faced, with an event that materially affects almost, I would say, any company in the world, most negatively, some perhaps positively. And I would like to ask you whether you think that the concept of materiality needs to be rethought as a concept now in this time, whether it can apply indeed as it stands in this extraordinary moment.
Well, materiality in itself, in the audit perspective, they use certain metrics tied to assets, tied to earnings, et cetera, to determine what is material. But the actual definition is that what is going to change the decision of a known and or proximate user of financial information. And so I think it's important that I wouldn't change the policy or the guidelines for materiality. The key is greater enforcement. You can have great rules, but if the board isn't standing up, if the audit committee is not standing up, and most importantly, the investors are not standing up and saying, listen, we need to know the assumptions that are being used when you're setting credit provisions. You're telling me that you've taken the worst case scenario. What assumptions went into these provisions such that I can assess that it actually is a worst case scenario that you're painting when you're setting these provisions? Just as an example.
That's very interesting. And I want to go back a little bit, bring this conversation a little bit closer to where you sit, and your firm has a particular approach as to how you assess various risks. And if I understood it correctly, you look at accounting disclosure, balance sheet risk, cash flow, sustainability, quality of business operations, and last but not least, a subject very close to my heart, corporate governance. And you said, and I quote, governance is not something that you can include in your valuation. It's like oxygen. You only know how much you need it when it isn't there. And I think, obviously that's all music to my ears. But I would like to ask you how you operate, well, I think two questions really. How you first operationalize all these concepts and how you bring them together to interact in real life. And second, to the extent that you've looked at some real examples of governance lapses in Canada, but also in other markets, what are some of the lessons learned? What have you uncovered in recent episodes?
Sure. So first, to your first question, we have those 5 criteria. We rate each of those 5 equally out of 5, and we come up with what we call our quality rating. And there's actual method to the madness that we rate, for example, corporate governance and accounting both at 5, because and same with business operations. You can have a great a great business model, but if you have a poor operator, we have a problem. If you have poor governance, we'll have a problem eventually, or that business will not be able to realize its full potential because we have different obstacles within the organization that are getting in the way. So that's kind of, if I had to think of it, to explain to you the methodology, and that's the quality rating out of 25. And then the other part of our rating is just an intrinsic value. So if you can see the way the two work. So for example, you have a high quality company that rates, for example, 20 out of 25, but the intrinsic value suggests that it's fully valued and or could be overvalued. You have another company that could be very low on the quality scale, but if things go right, there could be significant upside. And that's how we intermingle the 2 ratings to determine what we determine to be a buy and a sell. And we only do buys and sells. We don't do holds. We don't do sector perform, market perform. I have no idea what those concepts mean. They're actually useless, I think, to the investor. Any investor wants to know, am I buying a stock today? Am I selling it? That's the only thing you need to know. Holding, I don't know what that means. So that's the structure. And if I had to just take it now to think about, as you said, perhaps some examples of how governance plays a role in a company's results and assessing what the performance will be. One of my favorites of all times is Bombardier, and the global company. You know, it started out as a snowmobile manufacturer, mushroomed into building commercial jets, business jets, transportation, high-speed trains, global footprint, etc. One of Canada's champions. And I remember writing a report and doing a lot of work in 2000, 2001 in this. And we identified that essentially every single accounting policy choice, and this is the important thing, when you ask a company a question and they say, well, this is the way the accounting standard requires us to do it, I know that there's a problem with that answer, because everything is a gray area. The accounting policies are principles based. And so that means that you have a gray area, which is, I like to give the example, you know, if I told you have to come to a complete stop at a stop sign, what's that mean? Well, does it mean stop for 3 seconds, stop only when it's raining, slow down just so you can see what's going on around you, stop just that you can, you know, make look and see if someone's walking? In other words, there's lots of interpretation of what it means to come to a complete stop. Same thing for all policy, all principles in accounting. So when we started looking at Bombardier back in 2000, we identified that every single accounting choice that they made and presentation that they provided to investors served to increase their earnings and or margin presentation. And so we said, you know, slight changes in the assumptions would have changed the overall performance materially. And so it's not that I know what the earnings should be and the company knows what the numbers are from the account, the company are right. It's not about right and wrong. It's about saying, wait a minute, there's a lot of subjectivity in their numbers, and I can get to a number that has a significant delta. And so when we identified that, and this is now stocks trading at $18, it's actually now trading at 50 cents. On the way, you know, up and down and throughout, and asset sales and all kinds of things that happen. And so what I often find is investors will get sucked into stories. And this is the most dangerous thing in investing. We listen to management. There's a charismatic leader, extremely dangerous. Okay. And one of the poster childs of this was Valiant. Okay, it took the world by storm as this new pharmaceutical approach. We're going to grow through acquisition. Research and development is stupid. We're going to buy companies, cut costs, and increase the business. I mean, that's an old story. And we identified problems with their financial reporting, their debt, The way they were reporting their non-GAAP metrics had a material difference to what was actually being reported, and nobody cared. In fact, we were ridiculed, canceled clients, people making fun of us. And what I eventually ended up happening, obviously, is the company went on the verge of bankruptcy, in 2015 after running up for the better part of 5 years. But what I think it's important to understand is when you have garbage inputs and people get sucked in, it's like, well, they seem to be running a questionable business, but the stock's going up, so everything must be fine. Well, it seems like I don't trust this management, but the stock's going up. And that's the problem. Just because the stock's going up doesn't mean that underneath everything's fine.
No, I think that, well, you've raised 3 or 4, I don't even know where to go with this, because you've raised 3 or 4 very interesting topics in terms of, first, the gray areas in accounting, and frankly, the same gray areas apply or exist in the world of governance. And I'm always amazed sometimes when you discuss with the boards and executives on governance questions, when they don't want to go there, when they know they have a problem, often say, we've introduced governance 5 years ago, as if it was a building block that you just sit there and it sort of sits and waits. And at first I thought it was perhaps a question of interpretation from different languages, but actually it's a question of corporate culture and mentality. So I really second you on that. Second point, I think it's very interesting that you raised is some of the company examples, because I'm also Canadian, proudly so, but Canada is often seen as a jurisdiction with that's very clean, and it's largely true, but it also has some serious issues that your research has highlighted with specific companies. But I would like to perhaps take this discussion and apply it to a slightly different context, and sort of talk about a little bit more about the crisis, but not necessarily in the context of publicly listed companies, because as we know, listings worldwide have essentially halved. So all over developed markets, I mean, we've seen an enormous decrease in listings. And this is something I'm actually covering in a forthcoming piece talking about dual listed companies and the risks involved in those, in investing in those. But for the purpose of this conversation, I'd like to shift gears and talk about privately held companies. And private equity as an asset class has, of course, skyrocketed, with the result that institutional investors, be they private, sovereign, Canadian, Saudi, others, are allocating increasing amounts of increasing their allocations to that as an asset class. And yet we know, if we look at some examples, for example, the Abraj case in Dubai, there are some large private equity companies that have had serious governance problems and have actually gone, in the case of Abraj, bust. So my question to you, Anthony, is whether, if you look at a privately held company, private equity, other privately held enterprises, would your approach to looking at their financials, looking at their governance, be slightly different, or this largely the same that you would employ in looking at a publicly listed entity?
Same approach. Our approach starts with evaluating what is the financial reporting and governance environment. And that's important, because then the next step of our approach is 3 steps, is to understand sort of what kind of flammable items there are. That is, things that if something goes right, will go perfectly. In other words, they have a brand new product that's being launched, or management that is very capable, or they're opening a new facility. Conversely, they have changed their accounting policy. They have put in a new non-GAAP metric that they're using. These are all flammable items. In other words, by themselves, they don't necessarily mean positive or negative. They can go either way. But then when you're faced with a spark, that's the 3rd step, which is that something goes wrong. COVID, competitive shock, economic shock, something happens, and then all of a sudden there's a blow up. And so if you have a good environment of governance, then that stays contained, that blow up. If you have a bad environment, then the blow up explodes and the company valuation could completely explode. In the case of private equity, it really depends on who the investors are. And we saw this with the example of like SoftBank and WeWork, et cetera. I mean, you'd think that so-called sophisticated investors don't get sucked into stories. They get sucked in all the same, okay? And the business model built on debt, built on leveraging the landlords to lower leases and rates and so on. It's really, it only works when everything's going from the lower left to the upper right. Anytime that there's a shock to come, it's not going to work. And then if you look at the background of some of the executives that were involved in that WeWork, you say, why would I want to give these people money? And so it's amazing how the same things happen. And my concern is that, and what I think is going to happen, which you're probably going to ask me next, so I'll anticipate the play here, is that these private equity businesses are going to need capital. And they're going to realize that they went private with lots of debt, and all that debt is coming now due in the next 2-3 years. And you're going to see a number of equity issuances with companies going public at considerably lower valuations than many of these private equity firms first dreamed that they were worth.
That's very interesting, because it's not a conventional view that there would be an increase in equity listings worldwide, but something that perhaps it's worth to discuss in a future dialogue. But for the purpose of this conversation, I'll try to limit it to a number of what I think are kind of burning questions. And you raised the example of Valiant, but other examples as well. And in previous conversations, for example, we had hosted Hui Chen, who is an internationally renowned integrity and compliance expert, and she spoke about her concerns around increase of fraud as a result of the COVID crisis, fostered by a number of factors, including in the pharma and biotech and other sectors. And I would like to ask you if you agree that the current environment is actually facilitating, what can facilitate an increase in outright corporate fraud in specific sectors, or perhaps across the board.
I think this is a good sort of tie back to where we started. Companies won't cheat unless they have to cover something up. When we've interviewed fraudsters, and I have had the pleasure of speaking to some that have gone to jail, Andy Fastow, for example, and the business doesn't start out as a fraud. It starts out that as a great business idea with a good market potential. And then something happens. There's, oh, you know what? We're going to have a hard time making earnings this quarter. So you know what? We're going to sort of stretch out the revenue recognition. We'll recognize some sales early. We'll make the numbers. Oh, next quarter, now we need to do something else because the margin's getting tight on that product. No problem. Why don't we change the valuation method for our inventory and we'll make the numbers this quarter? My point is, it starts out small and then accelerates. This situation we're here right now because of COVID, it's now creating that shock that will expose those environments that don't have a strong culture. You talk about what governance is about. Governance is something I like to say that you do when no one's watching, okay? And you can't, it's something that takes time. You can't just snap your fingers and go, hey, we have better governance now. It's something that has to permeate top down in how decisions are made. And so I would say that it's not necessarily that, the structure of the regulatory environment's any different today, such that, it's going to lead to more frauds. It's just that if I'm a pharmaceutical company today and if I can just push the envelope a little bit and pretend that the results of my clinical trials show that I'm going to do better results for COVID vaccine, my valuation of my company is going to go up astronomically. So the risk reward is skewed, right? And because I might be being paid in stock options, et cetera, it's all integrated.
Yes, I think executive remuneration is another subject that we won't have time to talk about today, but perhaps for the purpose of today's conversation, I wonder if you have any sort of last thoughts, and in particular, focusing on your advisory roles with the regulators. Do you think that there are going to be tectonic shifts, or perhaps less tectonic shifts in kind of regulatory approaches as far as the Canadian market is concerned, or even your role with the international standard setter?
I think it's still too early to say if there's going to be any changes that come, but for sure there will be some changes. that will come about. They're working on certain changes right now where operating income will somehow be presented on the income statement under IFRS. As well, there's a new section of the audit report, which is now being implemented, called the key audit matters or critical audit matters, and that's a separate section. I strongly encourage investors to pay attention to that, because that's like the issues that the auditors saw as being concerning. So, do I think that something will come out of this? It depends on what the fallout is. You know, if you look at the global indices, and let's just really the largely in North America, you'd almost look at the performance of the S&P and say, COVID? What COVID? There's no problems. Everything's fine. The index is down like 10% from the all-time high, and it's like nothing happened. And so, meantime, there's more unemployed people in America than there are Canadians living in Canada. We have global economic type rates of GDP, et cetera, that are depression-like numbers. So it depends on how all this plays out, how it reverberates. Then you're going to see the regulators step up and say, "Oh, I have a way to fix this."
Well, I think that what you're saying, if I hear you correctly, is we haven't necessarily heard the whole song play out, and so some of it is to be followed. And I think, I hope that in the future conversations and governance dialogues, we'll have a chance to speak to you more about some of the issues that you've been raising on executive compensation, on accounting standards, on some of these emerging challenges. But perhaps for the purpose of today's dialogue, as we promised to keep them manageable for our viewers to about half an hour, we'll try to summarize it here. But thank you so much, Anthony, for sharing your views from Canada, but also on global priorities. I think it's really insightful for the investor community.
Thanks very much, Alissa, and all the best to you. Keep up the good work.
Thank you so much. And for our viewers, thank you for joining us for this episode of Governance Dialogues with Anthony Scilipoti, the CEO of Veritas Investment Corporation, based in Canada. And I encourage you to have a look at their website for some really interesting research that they produce, and subscribe if you wish to our channel, where you could view future episodes of Governance Dialogues. Thank you for tuning in.